As we know, the stock market's pretty much been in downturn since the beginning of the year. And times like this could be a little scary investing in a volatile market. So that's what I'm here to talk about today. Oh, and by the way, I got a new intro. Let me know what you think about it. Eddie V here. If you're new to my channel, I discuss investing in dividend stocks, ETFs, personal finance, all while sharing my personal investing journey. So as I mentioned, I'm going to give you 4 quick tips on investing in a volatile market. And at time of recording, the S&P 500 has been down about 8.5%. And fun fact, today is February 22nd, 22. I just thought that was kind of cool. Anyways, on to tip number 1. So you want to keep emotion out of your investing. Generally, when you get emotional when investing, you either sell too early or you buy too late. You could see the prices you're looking at is rising and you're like, oh, I want to get onto this bandwagon. And as soon as you hit buy, 2 days later, the stock price starts to fall. And it's because everyone is selling now that the price has gone up, because they're like, oh, I got 5% back. Let me get out of here. And you end up losing money that way. Or you sell too early and you like, see the market's falling, let me hit sell, and 2 days later the price could start going back up. So you never know what the future is. So with that, you want to make sure, instead of being emotional when you're investing, make sure you stick to what your strategy is. And if you have a long-term strategy, let's say you have these 20 dividend stocks, and you're like, all right, I'm going to invest X amount into different ones. Or you say, you know what, I have these 20 stocks and then I'm only going to invest on certain stocks when I feel like it's a fair price. And you plan to hold that for the long run. Don't just sell out of it just because the price is going down. Tip number 2 is on the flip side. If you put money in the market for the short term, at times like this, you might want to think about taking it out. Meaning if you don't have a fully funded emergency fund, and generally it's wise to have 3 to 6 months emergency fund. And instead of having that emergency cash on the side, you end up putting it into the market. It's not gonna always be available for you when you're in the stock market. So have money in there short term. You might want to take that out, or if you're close to retirement, you might want to move into less volatile assets. If you found value in these tips, let me know by smashing the like button. And also, if you haven't already, consider subscribing to the channel. Love to have you along for my investing journey. Tip number 3 is that be reasonable and understand that there is some risk investing in the stock market. Have some bad news. Stock shares are not always going to be increasing in value. There are going to be times they fall and we enter into a bear market, stock correction, kind of like we are now. And we did have a short bear market kind of in March 2020, and ever since then it's pretty much been rising, all-time highs here and there. But just keep in mind that there is risk involved, and you want to have some diversity with what you're investing in. So if you're new to investing in a market, think about starting off with the ETF, so you have a large basket of stocks and you're not putting all your eggs in one basket, because putting your eggs in, let's just say 5, 10 stocks, all those stocks that you pick may all fall at the same time, and then it goes back to tip number 1, you get emotional, like, oh, I want to sell and everything. Understanding that times stock will fall. Tip number 4 is to kind of hedge against risk with the stock market and all the volatility. Dollar cost averaging could be your best friend. And if you don't know, dollar cost averaging is basically you have a set amount of money you're going to consistently invest at a specific times. Maybe let's just say 100 weekly, or maybe do 200 every month. You want to stay consistent with that. And over a long period of time, you end up having to average share price. You're not really banking on timing the market, meaning selling at the highs or buying at the lows. You're just going to consistently continue investing no matter what the share price is or what's happening in the market. And you'll do very well in the long run. A bonus tip also is when the market is falling, consider taking advantage of those opportunities to get stocks on sale. Just think about it this way, on Black Friday, you know, no one's complaining about getting a flat screen TV, new laptop, camera on sale. Think of it also in the stock market. You have been investing in these 20 stocks. Let's just say you have your plan is 5, 10 years down the road. Now you see, hey, these stocks prices are going down. I can buy a share for them on sale. Right now, for me personally, this week, I'm looking at 3M and Intel. Their share price is going down. I can take advantage of that and buy shares on sale, as I mentioned, and in the long run, build up my position. And sometimes being in the red could be a good thing, especially since the last few months to a year, stocks have been overpriced, could be at a fair value or be undervalued, and you can capitalize on that. And there you have it, my quick tips on how to invest in the volatile market. And let me know down in the comments what your long-term strategy is while investing in bear market or stock correction as we are in now. With that, I'll catch you in the next one. Peace.